What if this brutal collapse in gold and silver isn't the disaster everyone believes it is, but the exact moment some of the world's smartest investors have been patiently waiting for? For weeks, fear has dominated the headlines, prices have continued to slide, and thousands of investors are beginning to question everything they thought they knew about precious metals. But beneath this panic, something far more important may be unfolding. Hidden inside the charts, buried beneath the selling pressure, are price levels that have historically changed fortunes. And if history is preparing to repeat itself, the biggest opportunity may arrive when confidence completely disappears. Today, the evidence points toward a strategy very few people are discussing. And before this video ends, you'll understand why this market flush could become one of the most important moments of the entire precious metals cycle. Welcome to Next Alert, where we cut through the noise and focus on what truly moves the global economy. If you're someone who values careful analysis over sensational headlines, consider subscribing and becoming part of our growing community. And if you're joining us today, let us know in the comments where you're watching from. It's always a pleasure to see viewers from around the world sharing this journey with us. Now, let's uncover what the market doesn't want ordinary investors to see. The collapse unfolding across the precious metals market was beginning to look far more serious than an ordinary correction. Gold was losing key support levels that many investors believed would never break. Silver had entered another aggressive wave of selling, and mining stocks were following the decline with even greater intensity. Financial headlines focused almost entirely on fear, while market commentators debated whether the decade-long bull story had finally reached its end. To the average investor, the message seemed obvious. Prices were falling, confidence was fading, and selling appeared to be the safest decision. But history has rarely rewarded decisions made during moments of maximum fear. Throughout modern financial history, the largest investment opportunities have often appeared disguised as market disasters. During the biggest corrections, emotions become louder than facts. Television experts predict even lower prices. Social media fills with panic. Long-term investors begin questioning their own strategies, while short-term traders rush to protect whatever gains remain. Yet beneath all of that emotion, another group quietly begins paying attention. Professional investors rarely chase excitement. Instead, they study probability. They understand that markets move in cycles driven by psychology as much as economics. When fear reaches extreme levels, they begin asking a very different question. Not how much lower can prices fall, but rather, at what level does the risk become smaller than the potential reward? That question is becoming increasingly important today. The current sell-off is not occurring in isolation. Around the world, investors are facing uncertainty on multiple fronts. Inflation remains stubborn despite years of aggressive monetary policy. Government debt continues climbing to historic levels. Central banks are attempting to balance slowing economic growth with persistent inflationary pressures, a task that has rarely ended without unexpected consequences. Meanwhile, global markets are becoming increasingly sensitive to every economic report, every interest rate decision, and every geopolitical headline. In this environment, precious metals have become one of the most closely watched asset classes in the world. Ironically, that attention has created even greater volatility. Many retail investors entered the market believing gold and silver could only move in one direction. As prices surged, optimism became almost universal. Forecasts grew more aggressive with every new high, and many participants forgot one of the oldest rules in financial markets. Nothing moves in a straight line forever. Every major bull market experiences corrections. Some are shallow, others are severe enough to convince investors that the long-term trend has completely failed. The challenge is knowing the difference. That is where discipline begins, separating experienced investors from emotional ones. Instead of reacting to every decline, professionals study the structure behind the movement. They examine historical support zones, trading volume, institutional positioning, and long-term market cycles. Their objective is not to predict the exact bottom. Their objective is to identify areas where probability begins shifting in their favor. That shift may now be approaching. Several technical levels that have acted as major turning points during previous market cycles are rapidly coming into focus. If prices continue falling toward those zones, they could attract a completely different class of buyers. Investors who have been waiting patiently while others rushed into the market near its highs. The remarkable part is that these investors are not hoping for panic to end before acting. They understand that opportunity often appears, while fear is still dominating every headline. And as this historic flush continues to unfold, one critical question remains unanswered. Are these falling prices signaling the beginning of a much deeper collapse? Or are they quietly preparing the foundation for the next major chapter in the precious metals market? Somewhere inside every major market correction, there comes a moment when two completely different stories begin unfolding at the same time. One story belongs to the crowd, the other belongs to the institutions. To most investors, today's price action looks like confirmation that something is fundamentally broken. Every decline feels like proof that selling was the correct decision. Every failed rally creates another wave of doubt. As prices continue slipping lower, confidence evaporates and fear quietly takes control of decision-making. But beneath that emotional surface, another process is already beginning. Large institutional investors rarely ask whether today's news sounds optimistic. Instead, they ask where the market is forcing weak hands to surrender. They know that panic creates liquidity, and liquidity creates opportunity. Every emotional sale from one participant becomes a potential entry for another. This difference in thinking explains why history repeatedly shows ordinary investors selling near major lows, while experienced capital quietly begins accumulating positions. The charts are now approaching exactly the kind of territory where that battle becomes visible. Technical analysis is often misunderstood because many people believe it predicts the future. It does not. Its real purpose is to identify areas where probability begins shifting. Every chart tells a story. It records every moment when buyers believed an asset was undervalued and every moment sellers decided risk was simply too great. Over time, those decisions leave behind footprints, zones where supply and demand previously collided with unusual intensity. Those footprints rarely disappear. Instead, markets have a remarkable tendency to revisit them. Silver is now approaching one of those historical areas, not because the number itself holds magical significance, but because previous buying activity transformed that region into a psychological battlefield. Investors who missed earlier opportunities remember it. Institutions remember it. Algorithms recognize it. Even traders who suffered losses often react when price returns there. That collective memory creates something powerful. Potential demand. But experienced investors almost never assume that the first support level will hold. Markets are emotional, and emotions frequently overshoot. This is why professional money managers rarely invest all their capital at a single price. Instead, they divide their buying into carefully planned stages. If the market declines further, their average entry improves rather than their confidence collapsing. This approach transforms uncertainty into an advantage. Instead of fearing lower prices, they prepare for them. Imagine two investors watching silver fall another 5%. The first investor begins questioning every previous decision. Anxiety replaces discipline. News headlines become increasingly influential, and every market commentator suddenly sounds convincing. The second investor reacts very differently. Nothing changes. The next predetermined buying level simply becomes active. No panic. No excitement. Only execution. That difference may appear simple, but over decades it separates consistent wealth builders from emotional traders. Gold presents a remarkably similar picture. Several historical support regions are beginning to align with long-term technical structures that have influenced previous market cycles. None of these levels guarantee an immediate reversal. Markets owe certainty to no one. However, they provide something far more valuable, a framework for disciplined decision-making. This is precisely where patience becomes a competitive advantage. While many investors continue searching for reassurance before taking action, institutional capital often prefers uncertainty. By the time confidence finally returns, prices have frequently moved far beyond the most attractive opportunities. History demonstrates this pattern repeatedly. The strongest rallies rarely begin when headlines become positive. They begin when almost nobody believes recovery is possible. That possibility raises an even larger question. If technical support is only one piece of the puzzle, what larger economic forces are quietly shaping the next major move in gold and silver? Because the answer may have very little to do with the charts themselves. Most investors believe gold and silver rise because people become afraid. That explanation sounds simple. It is also incomplete. The real drivers of precious metals rarely make front-page headlines. Long before prices begin climbing, invisible forces are already moving beneath the global financial system. They develop quietly inside central bank meeting rooms, government balance sheets, bond markets, and currency exchanges. By the time ordinary investors recognize those forces, much of the opportunity has already disappeared. Today's sell-off has distracted millions of investors from a far more important question. What is happening behind the scenes while everyone is watching the falling price? The answer begins with liquidity. Modern financial markets operate on liquidity more than emotion. When liquidity is abundant, investors become comfortable taking risk. Stocks rise, credit expands, and speculative assets often outperform. But when liquidity begins tightening, everything changes. Institutions become selective. Hedge funds reduce leverage. Large investors sell profitable positions simply to raise cash. That process often catches precious metals in the crossfire. Gold and silver are sometimes sold not because investors suddenly dislike them, but because capital is needed somewhere else. Liquidity shortages force selling across multiple asset classes, regardless of long-term fundamentals. To an inexperienced investor, that decline looks like weakness. To experienced capital, it often looks temporary. This distinction has repeated itself throughout modern financial history. Every major monetary cycle begins with confusion. Markets react violently to interest rate decisions. Economists argue over inflation forecasts. Governments announce new spending packages, while central banks promise stability. Each policy appears isolated, yet together they reshape the value of money itself. That is where precious metals begin telling a different story. Gold has survived every paper currency experiment in history for one simple reason. It cannot be printed. Silver occupies an even more unusual position. Unlike gold, silver is not only a monetary asset, it is also an industrial metal used in solar technology, electronics, medical equipment, advanced manufacturing, and artificial intelligence infrastructure. Every year, industries consume enormous quantities of silver, while investors compete for the same limited supply. This creates a market unlike almost any other commodity. One side of demand is driven by factories, the other is driven by fear. When those two forces eventually move in the same direction, supply can tighten much faster than many investors expect. Central banks understand this reality better than most. For years, many of them have steadily increased their gold reserves while reducing their dependence on foreign currencies. They are not making emotional decisions based on daily price movements. They are preparing for a financial world that may look very different 10 years from now. Meanwhile, global debt continues reaching levels that previous generations could hardly imagine. Governments continue borrowing. Interest payments continue rising. Currencies continue losing purchasing power over long periods. None of these developments create immediate explosions inside financial markets. Instead, they operate like pressure building inside a sealed container. At first, almost nothing appears different. Then, suddenly, everything changes. That possibility explains why sophisticated investors rarely judge precious metals by this week's chart alone. They study the larger monetary cycle. They understand that temporary weakness can exist inside powerful long-term trends. Perhaps the greatest mistake an investor can make is confusing price with value. Price reflects today's emotion. Value reflects tomorrow's reality. As fear dominates today's headlines, prices continue searching for equilibrium. Yet beneath that uncertainty, the structural foundations supporting precious metals have not disappeared. If anything, many of them have grown stronger. The market may still have one final wave of selling ahead, or it may already be approaching the point where patient capital quietly begins taking control. Either way, one truth remains unchanged. The investors who emerge strongest from major market cycles are rarely those who predict every short-term move correctly. They are the ones who build a disciplined strategy before the rest of the market realizes the cycle has already begun. And that brings the discussion to the most important question of all. Knowing everything the market has revealed so far, what should a disciplined investor actually do next? Every major financial cycle eventually reaches a point where information is no longer the deciding factor. Discipline is. By now, the market has revealed enough clues to understand what is happening. Gold has surrendered critical support levels. Silver has experienced an aggressive flush that has shaken confidence across the sector. Mining companies have followed the decline, amplifying the fear that the entire precious metals story may have reached its end. But seasoned investors know that markets often create their greatest opportunities at the exact moment they appear the least attractive. That does not mean buying blindly. It means following a strategy that removes emotion from every decision. The greatest misconception in investing is that successful investors know exactly where the bottom will form. History suggests otherwise. Even legendary investors have rarely purchased assets at the absolute low. Their advantage has never been perfect timing. Their advantage has been disciplined execution, careful risk management, and the patience to allow probability to work in their favor over time. That philosophy becomes especially important during periods like this. Imagine 3 possible paths from here. In the first scenario, precious metals stabilize over the coming weeks. Buyers gradually return, confidence slowly improves, and prices begin recovering before most investors believe the decline is over. Those waiting for complete certainty may find themselves chasing the market higher, paying significantly more than they could have during today's uncertainty. The second scenario is less comfortable. Selling pressure continues, support levels fail one after another, and fear reaches an even greater extreme. Financial media begins discussing the end of the precious metals bull market. Social platforms fill with frustration, while discouraged investors abandon positions they once believed they would hold for years. Ironically, this is often the stage where long-term capital becomes increasingly active, not because conditions look optimistic, because valuations become increasingly attractive. Then comes the third possibility. Markets experience one final wave of capitulation, a rapid decline designed to eliminate the remaining optimism before a lasting recovery begins. These moments are impossible to predict with precision, but they have appeared repeatedly throughout financial history. They are uncomfortable, emotionally exhausting, and often remembered as the turning points that very few people recognized while they were happening. Preparing for all 3 possibilities is far wiser than attempting to predict only one. That is why disciplined investors focus on capital allocation instead of market predictions. Rather than committing every dollar at one price, they build positions gradually. Each planned entry reflects preparation instead of emotion. If prices recover sooner than expected, they already have exposure. If markets continue falling, additional capital remains available to improve their long-term average. This approach transforms uncertainty into flexibility. Equally important is preserving liquidity. Opportunities have little value if investors exhaust their capital too early. Maintaining financial flexibility allows decisions to be driven by analysis rather than desperation. Cash is not a sign of hesitation. During volatile markets, it becomes a strategic asset capable of creating future opportunities. Another lesson often overlooked is the importance of separating headlines from long-term reality. News cycles operate by the hour. Investment cycles unfold over years. The market's daily fluctuations may dominate conversations today, but the structural forces shaping the future remain far larger than any single trading session. Rising sovereign debt, persistent inflationary pressures, geopolitical uncertainty, growing industrial demand for silver, and continued central bank interest in hard assets all represent trends that extend far beyond today's sell-off. None of them guarantee immediate gains. They simply remind disciplined investors that temporary price weakness does not automatically invalidate long-term value. Perhaps the most important question every investor should ask is not, where will gold or silver trade next week? A far more valuable question is, will today's decisions still make sense 5 years from now? That shift in perspective changes everything. Markets will always experience corrections. Fear will always create dramatic headlines. Predictions will continue to compete for attention. But wealth has consistently been built by those who prepared before certainty returned. As this extraordinary flush continues unfolding, the market is quietly presenting a test that every generation of investors eventually faces. Some will allow fear to write their investment decisions. Others will rely on preparation, patience, and disciplined execution. Years from now, when the next chapter of the precious metal cycle is written, the defining factor may not be who predicted the exact bottom. It may simply be who had the courage to follow a carefully constructed plan while everyone else was focused on the panic.